there's real potential for re-rating in the sector, and that will make specialised supported housing even more attractive to private capital. Fundamentals are strong, and we're confident that we can take Soho forwards under our management.
Hello, you're watching Proactive. Joining me today are Adrian D'Enrico, Michael Carey, and Natalie Markham from Atrato Partners, the newly appointed investment manager of the Social Housing REIT, or SOHO. Atrato took over in January. The team is here to talk both about the specialised supported housing sector and the SOHO portfolio, as well as share their plans for the future. So welcome all. And Adrian, I'm going to start with you. There have been some misconceptions about specialised supported housing sector in the past. Could you give us a quick overview of the sector, as well as why it is an investable asset?
Yeah, certainly. Thanks, Stephen. So specialised supported housing provides long-term homes for vulnerable adults with care needs. It's not temporary or homeless accommodation, which is short-term in nature, as the name suggests. Specialised supported housing residents often stay for life in our homes, which are specially adapted to meet their specific needs. A misconception as well is that specialised supported housing is a passive investment based on a long lease. Yes, we do have long leases in place, but the income security comes from the underlying resident occupancy, not just the leases. That's what ultimately pays the rent. So if you get the fundamentals right, and for us, that's the right property in the right location with suitable resident adaptations, it can deliver long-term inflation-aligned income, which is obviously attractive to shareholders. So we consider it operational real estate, offering long income rather than just a long lease strategy. As we know, resident occupancy is key, and the sector's had a considerable demand overhang for some time, and that's expected to grow to about 30,000 adults or so over the next decade. It's worth remembering, though, that that doesn't always translate to full occupancy in the properties, and that's because placements are very carefully managed, and it can take time to fill a scheme. But that's okay. Our schemes are sustainable and profitable above 80% occupancy, and our established portfolio is already at 86% and rising. We expect that to rise further as we complete the transfer of some assets from Parasol, one of our lessees, to Westmoreland, and we're following a similar process with our homes, which are currently leased to MySpace as well. So we're really positive about the outlook for Soho. We're already fixing the two key challenges, but we think we also need to do a bit of work restoring investor confidence in the sector. And that's both in terms of talking about the financial benefits it can offer to shareholders, but also the clear social impact it has for the residents as well. So to summarise our approach, we're addressing the tenant issues, and we're quite happy to take swift action when it's needed. We're very decisive. Looking further ahead, we're also seeing if we can restructure the income derived from our properties to further enhance the income security. That'll take some time, and we'll definitely keep shareholders updated as we progress. So what does this all mean? We believe that for Soho, there's really strong earnings growth potential, driven by a very attractive long-term debt profile. We've reduced our management fees following our appointment as well. We've moved those to a market cap basis, and that saves £2 million for Soho alone. And then we've got the inflation-linked income, of course, which will rise as we resolve those two portfolio challenges I mentioned earlier. So if we get these things right, and particularly if we manage to structure to secure our cash flows, we see there's real potential for re-rating in the sector, and that will make specialised supported housing even more attractive to private capital. Fundamentals are strong, and we're confident that we can take Soho forwards under our management.
Mike, we understand that some approved providers within your portfolio have faced challenges. Could you outline your strategy for addressing them?
Of course. So as you say, Stephen, there's been two well-publicised issues, one with Parasol and one with MySpace. So taking each one in turn and starting with Parasol, these leases were assigned to Westmoreland in August 2024 with a view of achieving 75 to 85% of the contracted amount over a 12-month period. And I'm pleased to say that since this assignment, so far, we've collected 72% of the contracted amount, and therefore confident that we can meet the upper end of that target. With MySpace, we're slightly earlier on that journey. So they stopped paying rent in June 24 and formally entered a CVA on the 7th of March 2025. But we've now taken control of that situation by agreeing an option to assign all of the MySpace leases to an alternative, better approved provider. I think what is key for us now is to ensure that we proactively monitor the other approved providers in the portfolio, so that when issues do arise, we deal with them quickly and decisively to avoid a repeat of the Parasol and the MySpace issues. I think just on that, to finish, it's important to say that the rest of the portfolio is performing well. And of course, both of these lease assignments should see rent collection improve in 2025. So when you combine that with cheap debt and annual rent inflation, that provides a really strong underpin to earnings growth.
Natalie, Soho's publishes full year results for the 12 months to the end of December 2024. Could you take us through the key highlights, please?
Of course, thanks, Stephen. So whilst we've seen a downward movement in the EPRA NTA from 114 pence per share to 99 pence per share, largely driven by the decline in valuations, which has come from an outward shift in the net initial yield to 6.22%. We think this probably represents a more realistic yield for the valuation of these portfolios. There is actually a lot in here to be very positive about. We've got a really good debt profile. We've got an 8.6 year average maturity and an all-in cost of 2.74%, which is obviously excellent. Rent collection was at 93%, and the dividend is still effectively covered on a cash basis, despite the well-publicised rent collection issues with MySpace and Parasol. So we're confident this rent collection, along with the revised management fee structure, we're going to be able to materially reduce the EPRA cost ratio and grow earnings and potentially the dividend.
Well, Adrian, Michael, Natalie, thank you all very much for speaking with us today. I hope you'll keep us posted on any progress with the fund.
Thank you.
Thank you.
That's Adrian D'Enrico, Michael Carey, and Natalie Markham from Atrato Partners.